Hey everyone, my name is Carl Lindgren. I am a certified financial planner and a wealth advisor here at Stabler Wealth Management. Now that we're into a new year, 2024, and that tax season is very much upon us, I just wanted to come to you today with a brief tax update. I've got a little presentation that I want to share with you, so I'll go ahead and share my screen. What we're going to do today is we're going to walk through some tax prep considerations for 2023. We're going to look at maybe some tax planning ideas, some updates for 2024, and then we'll just look at the reminder that in 2026, we're actually set to go back to the rates that we had in 2017, but I'll jump into that a bit later. So as far as tax prep considerations, just a reminder, hope everybody remembers the tax filing deadline is Tuesday, April 18th. That's actually my wife's birthday, so I'm really hoping that I remember at least one of those two things this year. You can, as long as you're kind of filing an extension, you can extend your taxes into October if you need to. 2023 is a pretty good year for investors. So what that might mean if you have a non-IRA is you may see higher taxes this year than you've seen, for instance, in 2022. The reason for that is we had a really strong stock market in 2023, so that could mean more capital gains. Additionally, with higher interest rates, that could mean that you see higher interest and higher dividend payments on your 1099 as well. As a reminder, you have until that April 18th tax filing deadline to make any contributions to an IRA or Roth, if you're doing like a backdoor Roth contribution. And then also if you turned 20, or if you turned 23, now if you turned 73 in 2023, you have until April 1st of 2024 to make your required minimum distribution for 2023. If you do that, though, if you elected to delay, you're going to have to take two required minimum distributions in 2024, both the 2023 and the 2024 distribution. But you do have that extended deadline for your very first required minimum if you turn 73 in 2023. A couple other things to think about. As far as making prior year contributions, as I mentioned in the previous slide, you have until the tax filing deadline of April 18th to make these contributions. The limits themselves for 2023, $6,500 for an IRA, a Roth, or a non-deductible contribution, which you may convert potentially to a Roth as a backdoor Roth contribution. Additionally, if you're over the age of 50, you can make another $1,000 contribution to any of those as well. If you were eligible to contribute to an HSA in 2023, you can make prior contributions to those as well, right? And so they obviously have a little bit different contribution limits, as well as that catch-up contribution starts at age 55 instead of 50. One thing to mention on the Roth IRA contribution, this is where you might consider doing either a backdoor Roth contribution, or if you're able to, doing the direct Roth contribution. For example, if you had under 218,000 of modified adjusted gross income, you're able to make, as a married couple, you're able to make a 2023 Roth contribution. If you had over 228,000 of modified adjusted gross income, you're no longer able to make that direct Roth contribution. So you might consider a backdoor Roth contribution. If you land in between the 218 and 228, you can contribute some, but not necessarily all of that 6,500. Jumping into 2024 updates and tax planning ideas, starting in 2024, I should mention, so every single year, the IRS applies what's called like an inflation adjustment to the tax brackets. What they're trying to do by doing that is essentially just avoid taxing you on the same type of lifestyle as inflation, eats away at your lifestyle a little bit. And so that's going to be about 5.4% this year. In addition to that, you're going to see an increased gift exclusion amount, which we'll talk about in a minute, as well as increased contribution limits to your retirement plans that we talked about in the last slide. We've got increased contributions for 2024. So looking at the tax brackets for 2024, we've got the same tax rates, but if you compare these to the 2023 tax rates, you'll see that you're allowed more income in any given bracket than you were last year. In addition, the standard deductions went up as well. This is that 5.4% that I mentioned on the last slide. If you compare it to the 2023 rates, you'll notice that it's increased by about 5.4%. Capital gains, as I hope most people know, are taxed at a bit more favorable rate than ordinary income. So we've got three capital gains rates still. We've got 0%, 15%, and 20%. Long-term capital gains are, you buy something, you hold it for over a year, and then you sell it for more than you bought it for. The IRS likes, of course, to tax you on that. And so when they do, though, they do give you a bit more favorable rate. Something to mention is that capital gains will not affect your ordinary income rate. So when we're looking at those ordinary income rates, 12, 15, 22, 24, those capital gains are not going to push you into a higher ordinary income rate. They can only push you into a higher capital gains rate. However, ordinary income, meaning dividends, interest, wages, that will push you both into a higher ordinary income rate and into a higher capital gains rate. As I mentioned earlier, we've got an increased gift exclusion. It moved from 17,000 up to 18,000 for 2024. Things to think about, if you're wanting to reduce the size of your estate, if you're fortunate enough to be in a situation where you can give away large sums of money, this is the cap at which you can give away 18,000 per person per year without ever having to file any reporting requirement with the IRS. You can certainly give more than that. If you do, though, there's just a reporting requirement with the IRS. And then, of course, looking at the increased contribution rates. So for any employer-sponsored plans like a 401k or a 403b, for example, those are now 23,000, up from 22,500 in 2023. The catch-up contribution is now 7,500. That's actually the same as it was last year. Similar to the IRAs, you have to be over 50 to make that catch-up contribution. For any type of IRA, pre-tax, Roth, non-deductible, we're increasing from 6,500 up to 7,000. Again, the catch-up contribution of $1,000 is remaining the same. And then for HSAs, we're now able to contribute 4,150 if you're an individual, or 8,300 if you're a family plan. And again, that $1,000 catch-up contribution is remaining the same. I know I mentioned backdoor Roths in the earlier slides, but I wanted to mention two Roth conversions. This is something to think about as a planning technique for 2024. If you're able to, if it makes sense, then you should probably consult with your financial advisor or your tax advisor before looking at this. But you may be able to move some money out of your pre-tax IRA and into your Roth IRA if you find that you're in a favorable tax rate for this year. So consider that. Feel free to check with us too as well if you have questions on that. Another thing to think about for 2024, just some charitable giving ideas for anyone who gives charitably. And by the way, this is separate from that $18,000 family or individual gifting limit that I mentioned. Charitable gifts are a bit different, and the IRS treats them different. And so couple ideas there. We've got these qualified charitable distributions, or QCDs. That's where you're allowed to, if you're over 70 and a half, you're allowed to pull money out of your IRA, give it directly to a charity, and you never have to show that as income on your tax return. In addition, something to consider is called donor advised funds. As I mentioned, we had a really strong year last year. And so if you find that you've got a whole bunch of gains and you don't necessarily want to sell that and pay tax on the gains from last year, if you're charitably inclined, you might consider a donor advised fund in 2024. Now, as I mentioned, looking ahead to that 2026 tax sunset. So back in 2017, with the Tax Cuts and Jobs Act, they kind of baked into the back end of that a sunset provision. And so long story short, if Congress does nothing, which wouldn't be unheard of, frankly, if they do nothing, we are actually set to go back to the 2017 tax rate. So we're all going to see a tax increase in 2026 unless Congress takes some sort of an action. What that's going to look like is you're going to see those individual incomes tax rates are going to increase a little bit, which I'll show you in a minute. You're going to see the estate tax rates, the exemption amount's going to come down quite a bit. And so they're still going to be pretty high in general, but it's going to be coming down quite a bit. And then what's called the state and local tax, or the SALT cap, is going to disappear. That was something that they baked in with the 2017 Tax Cuts Act. A couple other things too, we're going to have a lower child tax credit, and alternative minimum tax will come back. If we look at how that's going to affect us in 2026, this is just an example of where we're at in 2024 and then where we're going in 2026. So for example, if you're someone who has $100,000 of taxable income and you're a single taxpayer, you're going to be in that 22% tax rate in 2024. That's going to end up being more in the 25% tax rate in 2026. Same if you're a married couple, you might be able to show, 200,000 of income in 2024 at 22%. However, and this is something to consider too, notice that if you're at 200,000 of taxable income, not only does that bump you to 25, some of that income is actually going to be bumped all the way to 28%. So this is really the idea where that Roth conversion comes into consideration. Definitely check in with us, check with your tax advisor, your financial planner. We want to make sure that we're not tripping over any landmines as far as the net investment income tax or your Medicare premiums, if we're doing any Roth conversions. So that's all I had for you today. Thank you for tuning in, and I hope to see you again next time. All right, take care. Bye.